after a very lengthy bull market run that lasted for quite a while that now appears to be in jeopardy. With Donald Trump announcing tariffs on imports from China, Canada, and Mexico, it sent the stock market into panic mode. According to the White House's website, the extraordinary threat posed by illegal aliens and drugs, including deadly fentanyl, constitutes a national emergency under the International Emergency Economic Powers Act. Until the crisis is alleviated, President Donald J. Trump is implementing a 25% additional tariff on imports from Canada and Mexico and a 10% additional tariff on imports from China. Energy resources from Canada will have a lower 10% tariff. Initially performing well, the S&P 500 is now down for the year, and as of the making of this video, the sell-off isn't showing signs of slowing down. If these tariffs aren't lifted or scaled back like it's currently being speculated they might, then it's likely to negatively impact the economy and thus the stock market for a while. With that being said, if there is no scale back, then the period of easy money in the markets, especially in the NASDAQ, is likely to be over. We've had a really excellent past few years in both the major indexes, with the S&P 500 being up nearly 100% in the last 5 years and the NASDAQ being up over 158% before the sell-off started. A lot of the most well-known tech stocks, with their legions of cult-like followers, have started turning away from these once shining stars. Tesla stock is down 43% since December, MicroStrategy is down 37% since November, and Palantir is down almost 30% in just the last 3 weeks. It's by no means over for these companies or their stocks, but all this hype that we've been seeing from them is likely to fade as the market becomes more volatile. If we look at the performance of the S&P 500 from a yearly perspective, we can see that we've been blessed with great market returns following the financial crisis. Historically speaking, it's really unusual to have so many good years in the market. Because of the past decade, it's actually brought up the average yearly return in the S&P 500 to a little over 10%. Before that past decade, it was historically around 8 to 9% per year. But now we could be entering a period where making money in hype stocks, tech companies, and Bitcoin companies won't be as easy as it once was. These tariffs will have lasting impacts on the economy if Trump keeps them as he's outlined. It's during times like these that I've never been happier to be a dividend investor. I'm really glad right now that I don't invest in stocks with the goal of buying them at one share price and hoping to sell them later at a much higher share price. While everyone else is stressing out looking at stock charts, daily price movements, and their brokerage account balances, I'm instead looking at this. This is the transaction history of my account, which shows dividends and other types of distributions constantly being deposited into my brokerage account. Despite the market being down, and it could be down for a while, my dividend payments keep rolling in. And because I'm reinvesting the dividends on most of my holdings, every time I get paid, I use that money to buy more shares of my position, so my income is always growing higher. That's the thing about being a dividend investor. When you become a dividend investor, you view the market and share prices in a totally different way than everybody else. Rather than hoping that what you're investing in appreciates in value over time, you're instead building another income stream in your life by collecting dividends, like owning a rental property. But the big difference is that you don't have to worry about bad tenants, maintaining a property, or working through a property manager that takes a chunk of your income. Not to mention the huge barrier to entry right now. In most markets here in the US, home prices are still extremely high and rent is actually falling in many markets like Austin and Phoenix. So in my opinion, although rental properties are still a good way of making additional income, it's never been harder to get your foot in the door with rental properties. But the great thing about dividend stocks is that you can get started with less than $10. And no matter what the market is doing, whether it's going up or down, my dividend income keeps growing. And they do that through a combination of reinvesting them, and also a lot of my dividend stocks grow their distributions on a regular basis. If you've never considered dividend investing or income investing, which is focusing on much higher paying investments, then right now is a really good time to consider it. If you find that you're often stressed out with how the market is doing, then dividend investing will likely lower your blood pressure. I haven't panicked at all since this sell-off started, and in fact, I've actually been really eager to see my favorite stocks fall in share price, because every dollar that I invest going forward is now going to pay me even more dividends. Let's look at an example why investing for these distributions is great no matter what the market is doing, and why it's actually better when the market is tanking. Ares Capital is a very popular high-yielding business development company. Right now their stock currently offers a yield of 8.48% and they pay 48 cents for every share that you own every quarter. It's currently trading for $22.63 per share. We know the dividend is safe given their latest financial results, and we can see that it's been very safe for more than a decade. Let's assume that you have $10,000 that you want to invest in Ares Capital. Buying $10,000 worth of ARCC stock today would result in you buying 441 shares and would pay you $211.68 a quarter. But let's assume you instead wait to buy until there's a bear market. This is when the stock market drops by 20%, and to keep this example basic, we'll also assume that Ares stock will fall by 20% as well. Remember, their dividend is totally safe, it's just the market panicking. Doing the math, we can see that instead of buying 441 shares, you would own 567 shares, and that would pay you $272.16 a quarter. That's an additional $60.48 you're making every distribution. And since we're building up a cash-paying investment, we don't have to worry about stock market corrections or even a long-term bear market. When you focus on living off dividends and not selling shares of your stocks in ETFs, you're not impacted whatsoever by falling share prices. While all your day trading, hype stock investing friends are worried that their investments are going to fail, you can relax knowing that you don't invest for share price performance, but rather dividend payments. As long as the individual companies that you're investing in are still healthy, which is not always correlated to their stock share price performance, you won't have to worry about how the market is performing today. And even if you're really unlucky and you buy a lot of shares of a stock right before a correction, since you're not investing for share price gains, all you have to do is wait until the company's stock share price fully returns. Although investing for cash flow through dividends is a more laid-back strategy, I don't want to incorrectly paint the idea that it's easy. There are some things that dividend investors need to watch out for when it comes to investing in stocks and diversified funds. Although tempting, you should never invest in whatever is offering the highest yield because there's almost always a reason something is yielding so high. You need to familiarize yourself with what's considered a typical yield for a specific investment. For example, a 10% yielding equity REIT would be very suspicious, but pretty normal for a business development company. If a high-yielding position does have a long history of share price declines, that's also something that you'll want to be aware of. A long falling share price is usually a good indication of consistent dividend cuts, such as the case here. So with that being said, this is why I would argue that investing with the goal of dividends in mind is a better strategy during this kind of market. What you'll also find is many dividend-paying companies are usually less volatile, especially compared to what you'll find in the tech sector. That's because many of them have great track records of consistent dividend payments. Even if you don't want to entirely change investing strategies and just dedicate some of your portfolio towards dividends, it's still worth giving it a shot. Feel free to check out some of the other videos on this channel as I go in depth on many of the higher yielding asset classes and specific companies. Let me know your thoughts, but with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.